Hey there, welcome. Today, we are going to talk about a concept that totally flips the script on how we think about a company's success. It's called economic value added, or EVA for short. Trust me, it's a real game changer, and it all starts with one simple question. So let me ask you this. When a company reports, millions in profit, does that automatically mean it's making its investors richer? Your gut reaction is probably, well, yeah, of course. But what if I told you that a profitable company can actually be destroying wealth? The real answer, well, it's not what you think. The truth is actually hiding in plain sight, tucked away inside one of the most powerful ideas in all of modern finance. And by the end of this, I promise you, you're going to look at a company's profit report in a completely new way. To really get it, we first have to talk about something I like to call the profit illusion. That big gap between what looks good on paper and what's actually happening with an investor's money. Okay, so you've got two kinds of profit. There's accounting profit. That's what you see in the headlines. It's revenue minus all the obvious day-to-day costs. But then there's economic profit. And this is where it gets interesting, because it accounts for a massive, often invisible cost that the other one just ignores. Here's the kicker. Traditional profit completely leaves out the cost of the money used to make that profit. I'm talking about the capital, right? The money from investors and lenders. Think about it for a sec. That money isn't free. It comes with an expectation of a return. And if a company isn't earning enough to cover that hidden cost, is it really creating any value? And that, right there, is where our hero comes into the picture. To solve this problem, to see past the illusion, we need a better tool. We need economic value added. EVA was made popular by the consulting firm Stern Stewart & Co. way back in the late 80s. Its whole purpose is to measure a company's true economic profit. It shows you the value a company creates, but only after you've subtracted the cost of all the capital, both debt and equity, that it used to make that happen. The whole idea behind it is incredibly powerful and honestly pretty simple. It's just not enough to make a profit. You have to earn a return that's greater than your total cost of capital. Only then are you actually creating real, tangible wealth. So how do we actually figure this out? It might sound complicated, but the formula is surprisingly straightforward. Let's break it down into three simple pieces. First up, we need a really clean measure of profit. For that, we use something called NOPAT, which stands for net operating profit after tax. Just think of it as the cash a company makes from its core business, before paying interest on loans and things like that. It's the company's pure operational muscle. Okay, second piece. How much money is actually tied up in the business? That's what we call capital employed. It's the whole pot of money management has to work with. Every bit of it, from shareholder investments to bank loans, all combined. And finally, here's that crucial missing piece. The WACC, or weighted average cost of capital. If capital employed is the total amount of money, the WACC is the price tag on that money. It's the average rate the company has to pay back to its investors and lenders for the privilege of using their cash. All right, so putting it all together is super easy. Step 1, you get your operating profit, your NOPAT. Step 2, you figure out the capital charge. That's just the total capital multiplied by its cost, the WACC. And step 3, you subtract that charge from the profit. And boom, the number you have left, that's your economic value added. Let's make this concrete with a quick example. So imagine we've got a company with a nice, solid operating profit of £12 million. Now, to earn that, it used £100 million of capital. And the cost of that capital, its WACC, is 10%. So what's that hidden cost that traditional accounting just doesn't see? Well, you take the $100 million in capital and multiply it by that 10% WACC. The capital charge is £10 million. This is the minimum return, the hurdle, the company absolutely has to clear before it can say it's created any real value. And here it is. This is the big reveal. We take the $12 million in profit, we subtract that $10 million capital charge, and what are we left with? A positive £2 million. This is the real deal. This is the true economic value, the actual wealth the company generated for its investors. Okay, so that's the theory, right? But what does this actually mean in the real world? Why do some of the biggest companies on the planet swear by this metric? Let's take a look. The real power of EVA is that it changes how people think and act. See, instead of just chasing profits, managers are forced to ask better questions, like, okay, this new project looks profitable, but will it earn more than our 10% cost of capital? And if the answer is no, they don't do it. This relentless focus on value creation is exactly why giants like Coca-Cola and Siemens use it to guide their decisions. You see, what EVA really does is it builds a bridge. It connects the world of accounting numbers with the world of economic reality. It gives everyone, from the CEO to the investors, one clear number that says, here's how well we're actually using the money you gave us. So, as we start to wrap this up, let's just boil it all down to the one crucial thing you really need to remember. Now look, EBA isn't perfect. It's not some magic bullet. Calculating the cost of capital can get pretty complicated, and it does require some careful accounting tweaks. It's really more of a powerful way of thinking than a perfect, precise measurement. But even with those challenges, its core idea is what makes it so revolutionary. And this is the message right here. Profit by itself is not enough. A company can show a profit on its income statement and still be bleeding shareholder value if it isn't earning more than it costs to get its capital. Real success, true success, is all about creating returns above and beyond that cost. So, the next time you see a headline about some company's record-breaking profits, I hope you'll just stop for a second and ask yourself a better, smarter question. Yeah, but are they creating any value? Thanks so much for joining me.